Hi, it's me, Birger Schäfermeier. I'm a day trader and I really love this kind of business. For the past 23 years I make my living just with day trading. Today I want to give you some tips for this business and I want to talk about trading errors or trading mistakes. You know, trading is a business or a competition between human beings. And human beings make mistakes. That's normal, that's natural. So we should not be afraid to make sooner or later a mistake, and it's part of the game. The difference between a professional trader and a beginner is that the professional trader makes less errors and that all these errors the professional trader does are not so big like the errors of a beginner. There are some errors you can make and you will still stay in business. Maybe your profit and loss will be a little bit smaller than it should be, but it's not a problem at all to make some mistakes. What is a really huge problem, and about this issue I like to talk today to talk with you today, are some trading mistakes which are so huge and are so big that they will throw you out of business soon or later. So I think it's worth to listen to my video in the next 45 minutes. Let's start with the biggest trading mistakes at all. And this trading mistake is average down a position. What does it mean, average down? For example, if you're buying a stock at 100 and this stock is not running in your favor, instead the stock drops to 80, a lot of people think, oh, that's a good idea, now the stock is even cheaper than I bought it, and I want to own this stock, so it's a good idea to add more stocks to my portfolio. And buying another bunch of stocks at the price of 80. This will bring my average price down maybe to 90. And if the market going up to 100 to my first initial entry, I'm already in a profit and I already will earn money. That sounds great and that feels great if the market really comes up. And in such a case, you will make money. And it feels good if you add some positions and the average price came nearer to the market price, and when the market comes up then and you make money, everything is in perfect condition. But believe me, sooner or later the market will not turn, and in such a case you will have a huge problem, because you now have a very big position in your portfolio, and this position is not running in your favor. Good traders want to have a big position when the market is running in their favor. And they want only to have a small position when the market is not running in their favor, when the market is running against them. In such a case, they want to scale out. They want to offset the position. They want to have only a tiny position at all. They don't want to have a big position when the market is not running in our favor. So it's not a good idea to average down your position size when the market is going against you, because if the market is not snapping back to your entry price, you will have a huge problem because you don't know what to do. And the first time you do this average down, it will work for you, and maybe the second and third and the fourth, even the 10th time, it's maybe working for you. But sooner or later, there will be a big monster trade waiting behind the corner just for you to kill you. And this monster trade is when the market not coming back in your direction, or the market came back in your direction too late. Because most times, traders work with a leverage. Do you know what a leverage is? Leverage means that you pay not the full price for the stock, you maybe just pay 10% for the stock. If you pay for a 100 euro stock just 10 euro, your leverage is 10 times. So if the stock is moving up 1%, you're making 10% on your proprietary capital, on your own capital. And working with leverage is normal for traders. Yeah? So if you are trading CFDs, if you are trading Forex, if you are trading futures, or even if you are trading stocks with the Lombard credit or whatever, you are trading with leverage. And then you also will leverage up your problems when the market is not running in your direction. And here comes the story. I tell you a story about one of my customers. When I started my trading career, I worked at the broker. During that time, it was the internet it was not for granted that you have internet at a home. Yeah, so in 92, 93 in Germany, most of the people don't have internet at home, and so I decided during that time to work at a broker, because this broker had fixed lines to the exchange, and I could do my trading from that broker trading desk. Also, I have to care about the customer. That means that I have to pick up the telephone when the customer calls, take his order and punch this order into my computer and to get an execution for him at the Eurex, former called DTB, Deutsche Terminbörse. And in the year 1992, a customer was introduced to me with big portfolio, and he has a very simple strategy. It was a long-only strategy, and he starts buying for explaining reason. I cut his position size down to one lot, so it's easier to calculate everything. Yeah. So, for example, if he wants to be the DAX long, he bought one contract. During that time, one contract, 1 point was 100 Deutschmark worth. So, if the market is running in his favor, for example, 100 points, he owns 1000 Deutschmarks. And his strategy was very simple. He bought the DAX future, and when the market goes up 200 points, he offsets the position, wait for a pullback or for a retracement, and then he bought that DAX again, and he tries to sell this again with a profit of 200 points. Sometimes the market was not moving directly into his direction, and then his position was not in profit, his position was in negative, so came down. And his strategy was that he bought another contract every time when the market was 100 points against his initial position. So, for example, he starts buying the DAX future at 2000. When the DAX future came down to 1900, he bought another contract. So his average price was 1950. And when the market drops another 100 points to 1800, he bought another contract. So the average price came down to 1900. So if the market is now moving up from 1900 to 2200, his average position size was 3 contracts, and he owns, because his average price was 1900, and he owns then 300 points with 3 contracts or 9000 Deutschmarks. So this was a perfect strategy, because we were in bull market, and the market never came back more than 400 or 500 points. I think I could not remember it exactly, but you can watch the charts. I think the biggest drop was around about 1994, was around about 500 points or something like that. I think we came back from 2400 down to 1900, 1800, something like that. So during that period, from 1992 up to 1996, this investor or trader made a lot of money, and a lot of people in the office looked at the portfolio and said, wow, this man really knows how to make money. But his strategy was very simple. It was a long-only strategy, and every time when he was in loss, he averaged down his position size. And then the year 1997 came. In 1997, something very strange happens, or not strange, but it happens something which a thing which happens not before the past 10 years. In 1997 we had this Asia crisis. So there was a crisis in Asia, and this crisis was a huge threat for the stock markets worldwide. Also the DAX dropped during that time. And my investor, who bought nearly at the top the first position back, so he was long one DAX contract. Then the market dropped against him 100 points. He added one. He was 200 points, and the market dropped another 100 points. He added another contract, and so on and so on. At the end, in the middle of the year, the market dropped more than 1,000 points. And this investor was now more than 10 contracts long. So his really position size was bigger than 10 contracts, because I told you for explaining reason, and to simplify everything, I cut his initial position to 1. Yeah, but his initial position was bigger. So, but here, for our example, he owns now 10 DAX contracts. That means that 10 times 100 points, 1 point is worth. So every tick in the DAX was now 1,000 points. Deutschmarks. 1,000 Deutschmarks. Every tick. So if the market is moving 10 ticks, he lost 10,000. If the market is moving 100, he lost 100,000. So he was losing really much money for every point the market drops. And this huge bull market in 1997 was interrupted by this crisis. And it was a lot of pressure for him, because it was a leveraged position. And so sooner or later his portfolio dropped so much in the value that he got a margin call. And I had to call him and ask him for additional funds. So I picked up my telephone, called the customer and said, hey, come on, you have a lot of contracts in your portfolio, you have not enough margin, so I have to ask you to put or to wire additional funds in to hold this position. And this customer was really under pressure, because at that moment he already had lost more than 1 million, more than 2 million Deutschmarks. And so he decided to offset all the positions, and he said, okay, I'm pretty sure the market will go up sooner or later, but for the moment I will stop. I will please sell out my position, and when the market drops another 100 points, I will re-enter the market. And I really could remember when I offset his position, that was the hour of the low for the next 3 years, or no, more than 3 years in the market. We offset his position with more than 1 million loss, and after that the market went up straight away. So maybe said, okay, this investor only was too frightened. If he would have held his position, he would have made money, because the market is moving higher in 1908, 1999, 2000. But that's not the point. The point is that nobody, even if you have enough money, has the mental strength to hold such a loss. Sooner or later, there's so much pressure which stresses you that you're not able to hold your position. And the only thing what you want is to come out of this position, and you think, okay, I can enter later. But now I tell you a story, or I tell you, in the moment you offset the position, you feel relief, and you're happy that you're out. And then, when the market really made the low and came up, then you are struggling with yourself. Should you really enter? You remember all this pain you had in the past weeks, and so you will decide, not to enter again.
In this picture you could see what happened to my customer. In the beginning of the 90s there was never a drop more than 428 points down in the DAX future. So his strategy went perfect with averaging down, because even if he bought here at the top at the highest price, he just had to add 4 contracts more and he was out of his position sooner or later here with a huge profit. And during 95 and 96 his long-only strategy, buying DAX futures, worked perfectly and he made a lot of money. Then in 1997 he bought 1 contract here at that price, 4,380, and following his strategy and due to his strategy he has to add now every 100 points another contract at minimum, if we count this for 1 contract. So he bought the first one at 4,380 and the market never managed up to go up at 4,580, so he has to average down his position size, buying another lot at 4,280, at 4,180, and so on and so on. And he bought all these contracts during this drop here, and here the low was 3,360, and when the market was at 3,380 he was holding 10 DAX contracts. The average price was 3,380. So in this moment he was already in loss 5,000 DAX points. Calculating 100 points in the DAX, this means that his loss for this position was 500,000 Deutschmarks. During that period he lost all the money he won from 93 up to 97. So this whole account was blown, which he built up within 5 years, and this whole account was blown within just 4 months. So I think it's a very perfect example that averaging down will kill you sooner or later. Most times it will kill you later when you already made some money, but the problem is you will never know when it will kill you.
The second biggest trading error you could do is to trade with an opinion. Trading with an opinion will kill you sooner or later. Why? May you know a lot of traders who made a huge amount of money with an opinion. And you think, oh, I want to do this also. I want to follow these traders and I will make money because I'm pretty sure that there will be a crash or that the gold price is going up to 10,000, whatever. And you think if you have an opinion, it's worth to bet on that opinion. But to be honest, trading with an opinion will lead you sooner or later to a disaster. Why? Because it's so hard to change your opinion. Do you have ever in a discussion with somebody who is really convinced about something? It's hard to talk with such a guy and to convince him that he's not right. So now imagine you at the stock exchange. You're buying something and you're really convinced that this thing is going up. But this thing is not going up, it comes down. So what do? Because you have an opinion, you will hold your position. And you're not able to see all these red flags the market will show you. Yeah? You think, okay, The next level is big support. This support will hold. I don't have to do any risk management. I don't have to use any stops, because if I'm using stops, I maybe will be stopped out and then the market goes into my direction and I will make no money and I was only right with my opinion. And the one thing what could happen for a human being is to be right and make no money with that idea. So better you stay with your idea and you lose money than to see that the market is going in the direction you suppose that the market is going to, and you make no money. So a lot of traders who have an opinion are not flexible anymore. Yeah? They don't see all these opportunities in the other direction, and they are too rigid. And I made much money during the 90s with an opinion. I was so bullish about that market. And then the great bull market ends 2000. And if you have an opinion during that time and you stay with your opinion that the market is maybe going higher, then you will lose all the money you made before. I started together my trading business with a lot of other traders, and we were trading for a brokerage company, and we all were bullish for the market, or most of them are bullish for the market. But the guys who did not change their opinion in 2000, 2001, they are not trader anymore because they were wiped out by the market. Why? Because they were not flexible enough. And they were wiped out by this huge drop in 2000, 2001, 2002. Sure, the market came back. We are now at the all-time highs. But holding a long position 10 years with leverage, it's impossible. Yeah? So if you're a trader, don't trade with any opinion. It's an easy advice, but I know it's hard to follow. I tell you a story about myself. In 2012, I had an opinion. Yes, me. Yeah, you hear right. I give you the advice to trade without any opinion, and I, myself, have an opinion. Yeah. It was a huge trading error, and it was a huge trading mistake. In 2012, I believed that the German interest rate could not drop any further. Why? Because the interest rate for 2-year notes went down to 0. And my idea was nobody would be so crazy to pay the German government money to hold his money. Yeah? If you borrow money, you have to pay an interest. And if you lend money, you want to get an interest. But if you lend money to somebody and put an additional interest on that, a negative one, so you put additional bucks on the money you give to the borrower, it makes no sense, huh? So I think I was pretty sure the interest rate could not drop to negative. It would be impossible. So I started betting on rising interest rate. I decided to bet on the Bund future because the longer term gilts are they have a huge leverage, bigger leverage than the short term notes, and so I decided to bet that the Bund future will drop. That means that the interest rate will rise. And what happens? The interest rate dropped to 0, dropped below 0, and went negative. And I could not believe what happens. I said, hey, are these people crazy? Why are they why are all these people giving money to the German government and asking not for any interest? Instead, they put additional funds to the government and say, hey, I'm happy, keep my money, I just want back my 100,000 in 2 years, and I pay you another 200, 300 bucks, just that you keep my money. A crazy situation, no? But this situation happens in 2012. And I could not understand this. And I had an opinion that that's not possible. So I started really betting against this. And not with a small position size, a bigger position size, because I think it's a sure thing, it's a sure bet. And it sounds logic, but I did not have the Swiss central bank on my plan or card. Because this central bank has another target. Their target during that time was to keep the interest rate between the euro and the Swiss franc to 1.20 to fix this. And therefore they could buy euros and sell Swiss franc, or they could buy euro assets. And they decided to buy euro assets like the Bund future. And this makes that the interest rate from notes, bonds, and so keeps on to fall. And that hurts my position. So I lost during that time more than $250,000 within few weeks. And I'm very happy that during that time I already implemented some risk management to my trading, but the market was in a huge uptrend, and I never bet against an uptrend normally. But I thought during that time everything is different, and I really had an opinion, and this opinion cost me round about $250,000 within a few weeks. So if you like to trade with an opinion, you have to ask yourself, okay, what is this opinion worth? What would I like to pay for this opinion? If you are happy to pay for this opinion, so do this. But if you want to make money, don't trade with any opinion. Be flexible. Yeah? You see the market is going up, it goes up. And if it's not going up, change your mind, it goes down. So a trader should not have any opinion. He should be flexible. So market going up, he goes up. Market going down, he short sells the market. Market is on the sideway, he starts scalping. Market is in strong moving, he starts pyramiding. Yeah, so trader act to the different market conditions. A trader is able to adapt what the market is doing. Yeah, and he's not this guy and tell the market should do. The next trading mistake is the really reason why most of the traders lost money. If you ask me, I think that all the traders who lose money either have no experience, so it's impossible for them to make money, or if they have experience, they are afraid. If you're frightened, you will lose money. Why? Because you're not tough enough. You're not fast enough. You're struggling. Yeah? If you have an idea, but you're frightened that maybe you can lose money, you're waiting for confirmations. And confirmations cost you money. I will show you that here on this picture.
With this picture, I like to explain you why to be frightened or to be scared is such a big problem in trading. We have here the chart of the DAX future, and let us assume, just for this example, that we like to be long in this market, and we can see here on that day that the market opens on a lower level and turns sideways, and the question is where to enter the long side, and you have several possibilities. You could just trust the uptrend and buy here on the first level at 9320, and the best stop and the best initial stop would be the daily low. So the daily low is, in this example, 9290. To be honest, the price is not correct, but for calculating reasons it's better to calculate here with 9290. So let's assume we like to be long, and we would use a stop at 9290. And now, if we are scared and if we are not sure if the market is really going up, the trader would wait for a breakout, like on level 2, or even like here for if the market goes above the pre or day high, it's 9370. But for our example, let us assume that the trader will go long in the moment the market breaks through the daily high from the same day, and that's that level. If the trader is not scared and trusts the trend, he sees there's no upward momentum, no down momentum during that day, and so he may buys the DAX future here at that level 9320 with a stop of with a stop at 9290. So this is a 30-point stop. In the other example, we have the same stop because it does not make sense to move the stop just because we enter too late. And a lot of people try to move the stop to a bad level because they enter too late, and then they are wondering that they would be stopped out too often. Yeah. So the stop level should not change just because you change your entry level. The same is with the target level. The target should not change just because you enter too late or too early. So for this explaining reasons, we just assume that we have a target level here at 9410. That's the target level. And if we enter here at the first level without any fright and without any fear, then our risk reward ratio is 3 to 1. To wait 30 points for this breakout, the risk reward level changes from 3 to 1 to 1 to 1. May you think it's still a good level here because you have now this information that the market really breaks through that line, and this information is 30 points worth. But imagine what happens here. If you're trading risk-reward ratios from 3 to 1, that means that you only have to be right in 25% of the time. Yeah? So 75% of the time you could be wrong, and you will still be break even if you only be right one time of 3 times. So this is a 25% time, 25% hit rate you have to be right to be break even. And this hit rate you need to be break even changes dramatically if you enter too late. If you enter on that level and the second level, it is a little bit higher, but now the risk reward ratio is just 1 to 1. You can earn 60 points and you can lose 60 points. And if you have a risk reward level from 1 to 1, you already need a hit rate from 50% to break even. So your hit rate have to double to come to a break even trade, and that means that the information you got here, that the market really breaks through that line, costs you so much money that it's not worth to wait for that information. But if you are scared, if you feel fear, you never will dare to buy here. Yeah, so you wait for some kind of confirmation, some indicator may be changing in your direction, some breakthroughs from breakout, whatever. Yeah? And the typical thing is that trader may not want to pay for this information, and so they don't know what to do. So some people want to enter the market here, but even when the market breaks through that level, they're not able to enter, and they wait so that the market is going here to that level. And if you're buying here at 9,370, it's not shown in the picture, but now your risk reward level is below 0, and that's a very, very, very bad risk reward level. So to explain you this in detail in another picture, we can see this here in this Excel calculation. So
it feels so good to be right, and it hurts so much to be wrong. And because of that, a lot of traders don't want to be wrong. And to avoid to be wrong, they trade without a stop. And trading without a stop is a huge trading error. Trading without a stop will kill you soon or later. Why? Because sooner or later the market will move in a totally different direction than you expected. And because you're trading with leverage, you will be wiped out. So, for example, if you're trading Forex with a leverage from 100, the market just has to move 1% against you, and you were wiped out because you lost 100% of your money. If you're trading Forex with a leverage of 50, the market has to move against you 2%, and you will be wiped out. So that is too much leverage. Most traders use a leverage between 5 and 10%. 5 and 10 means that the market must move 20% against you to wipe you out. But even a drop or a rise of 20% could happen and will throw you out of the game. So, or will make a huge damage to your portfolio. So, trading without stop feels better as long as you are right. But if the market makes a huge move against you, and I promise you this will happen sooner or later, it will wipe you out. That's why you should never trade without any stop. Trade without a stop is the same like climbing on a high mountain without a safety rope. You can do that. And as long everything works, it's perfect. But sooner or later an accident will happen. And if you don't have any safety rope, you will die. Because in that moment you will drop so low that you will not survive that. And the same thing is in the trading business. You can trade without stop, but you should not. You should. If you're trading without a stop, your hit rate will be higher, because a lot of trades which would have been stopped out, the market came back sooner or later and you will make money. So you have a better hit rate. And you could avoid this feeling, this bad feeling of being stopped out. That's really annoying to be stopped out. No, it happens several times a day to me. But it's not a problem at all. Why? Why it's not a problem for me to trade without to trade with a stop? Why it's not a problem to be stopped out? Very easy. For me it's not a problem because I'm confident enough that I could make money with the next trade. I don't have to make money with each single trade. So if a trade is not working in my favor, I just scratch it. I'm confident enough that I can make money with the next trade. And if not the money with the next trade, I will make money with the trade after the next trade, or with the trade after the next trade, the next 100 trades. Sooner or later I will make money. But if you're trading without a stop, you missing confidence. There's a lack of confidence. That's the reason why you're trading without stop. You think you have to make money now. Why? If it's not possible for you to make money with the next trade or the trade after the next trade, then you're not a trader. Then you're a gambler. And then maybe you need the luck now. But if you're confident and you think, okay, here I am. This time, market is not going in my direction, that is. And I'm pretty sure I will make my money sooner or later with the next trade or the trade after the next trade. Then you don't have any problems with a stop. A lot of beginners miss this confidence. And they think it's possible to trade without a stop. It's impossible. If you're not able to cut your losses short, you will not make money. Your job as a trader is not to be right in 100% of the time. Nobody is able to do that. Your job is not even to be right 80% of the time or 70%. Even that is impossible over long term. Your job as a trader is different. Your job as a trader is to have good relation between your profits and your losses. So your average loss should be much smaller than your average win. And if you are able to manage that your average loss is smaller than your average win, you're a good trader. So, beginners think that good traders are right 100% of the time. A professional knows it doesn't matter how much I'm right. What I really can control and where I should focus on is how big are my average profits in relation to my average loss. And after that, they decide which hit rate I need. For example, if my average win is 2 times my average loss. So for example, if I'm earning 2 euros and losing 1 euros each time, I only have to be right 33% to break even. And if my average loss is only 1 euro and my average win is 4 euros, I have to be right only 20% to be break even. Typically, most of the traders have a hit rate of 50%. And if you're a good trader, maybe you earn 1.5 times of your losing trade and you will make money. That's my statistic. Roundabout I make 1.5 euros on every euro I lost. But my hit rate is 50%. So, after 1,000 trades, I made money. And that's the secret of trading.